Okay, you can join now. We can share.
Okay, so now click on share here.
Yeah, I have.
Is there a remote for that unit there? That's the camera there. Or is it here?
Yeah,
Oh, it's the one. Okay.
you can share.
What's that? Yeah. Yeah, you can. This is the remote for it. Yes, if it is connected, you should be able to actually reconnect it. As far as this camera, maybe.
It's being shared.
I don't know. Since I'm back.
Like you said, it's like.
Are you sharing that? Make sure you're sharing it.
Yes.
Okay, so he's sharing this and you can see it.
Yes, I'm wondering if we're gonna run the same problem that we ran into with the IC.
Yeah.
Nice.
Okay, so make sure if someone who is participant, can you see the slides?
When they see the slides.
First of all, can you hear us? Make sure that they can hear us.
Yeah, we can hear you. Paul Zink is on mute.
Yeah. Who see the slide and they can hear us. They are good.
So, yeah, basically.
Yeah, yes, of course. Yes, sir. You want to leave this one? Oh, yeah. No, it's not me. No, very fun.
Yeah.
And great topic. Maybe a topic I see yourself.
Good, right? Take something.
Testing 1, 2, 3.
Yeah.
Testing.
Up here.
Yeah. Testing 1, 2, 3.
Yep.
Yeah.
Good to go.
Yes, sir. I mean, okay. Get our attention. Okay. Yeah, good afternoon, everybody. Today's presentation is going to be special, and it's special because all along we've been talking about mining. Today we want to talk about the driving factors of mining, which is the finance, right? It happens to be one of the most important parts of mining. So our speaker today is a very unique professor. He's got more than 17 years in the banking sector. He's also got more than 42 years in the same sector, acting as M&A, different financing sector. So today we are happy and we'll be very fortunate to get his own part of the presentation today. Let's put our hands together for Professor Paul Zink.
Thank you. Thank you. I hope the online folks will stay in sync, but we'll try it. So I have been at Mines coming up on 5 years, and I warned the students who take my accounting and finance classes that they're going to learn a different language. Okay? It's a second language. It can be challenging because I'm so used to it after my career that I might use terms we don't understand. Please stop me if you do or question me to make sure you understand what I'm talking about, or at least as well as you want. I think of the language as the language of business. So a lot of companies, as you move up in management, you'll have to be familiar with the language to make sure you're part of the conversation. So again, feel free to stop me if there are things you don't understand or you want me to clarify as we go here. Has anybody here ever put together a business plan? Yep. For something? Okay, all right. So there are some elements to a business plan that that you're probably familiar with. If I can get the slides to advance here. So elements of a business plan or a business model, you've got to have a value proposition, right, for the customer. You've got to have a profit formula. You've got to figure out how you're going to generate revenue, how you're going to price your product or service. You've got to figure out what your cost structure looks like. And hopefully you leave enough room for profit. As I don't know if any of you have watched Shark Tank. If you've watched Shark Tank, you probably know who Mr. Wonderful is. One of his classic questions, Kevin O'Leary, to a presenter on Shark Tank that struck me years ago, was a lady came in and gave her pitch to the sharks. And when it came time for his questions, he asked her, "How long have you been doing this?" She said, "About 3 years." He said, "How much money, how much profit have you made?" She said, "None." He said, and he started laughing. He said, "Oh, so you don't have a business, you have a hobby." The point of business is you've got to make a profit. So you've got to figure that out. Then you've got to figure out what resources you need to deliver that value to the customer. And you've got to figure out the processes that, again, are going to generate that value for the customer. But it's important. So some companies, instead of trying to build from scratch, they try to buy. And companies think about acquiring. Okay? This is the M&A topic we're going to get on to. Typically, there are two rationales, at least for businesses that have been successful, arguably, at mergers or acquisitions. One is you're leveraging your current business model. You're building it up. You're creating some critical mass. Most of the acquisitions in the resource space, that's what they look like. You're trying to add reserves, trying to add maybe some geographic locations. Rarely is it the second approach of reinventing the business model, but that's not unheard of, where you're adding skill sets and capabilities that you don't currently have, or the like. Yeah.
So I wanted to make sure, I hear the word leveraging a lot, and I've always assumed what it means. It is just referring to like leveraging in the ways we use that in English language, not like a different definition in the business world.
In this, well, there are some different definitions of leverage in the business world, and this is actually a source of confusion sometimes for my finance students. Leverage can talk about the amount of risk you're willing to take on the balance sheet. Leverage can talk about how you are able to increase profits by increasing the scale of what you do, operating leverage. And then there's leveraging, just kind of building up the current business you have. So it can be used any or all of the above, and it's always good to try and clarify how the speaker's using that term in this case. But in this case, leverage we'll use as building up the business model, building critical mass, adding to what you already do, adding resources. Good question. So sometimes, though, companies go out to add capabilities to know how to do something they don't currently know how to do and be able to deliver that to a customer. That's called reinventing the business model. It might be a diversification into a new line of business, into a new mineral, to get experience with a whole new market. You could do it either way, and successful mergers and acquisitions do so. So why do companies use it? To build the critical mass, to expand their corporate reach, scale, get into a different market. Sometimes it is easier to buy a company with people already experienced in dealing in the local market than it is to try and build your own group there. So it might be used to expand corporate reach, to vertically integrate, upstream or downstream, changes your position in the market or where you are in the value chain. That's certainly a rationale to diversify into new industries we mentioned in reinventing the business model, to gain market share or to improve competitive strategic position, your market position. There might be a whole different dynamic, for instance, if you're just selling your concentrate from the mine, as opposed to getting into the next step, whether that's smelting or refining or something else. It might be a whole different dynamic for the marketing. And a way to, again, change your market position, to improve your market position, is move to a place in the value chain potentially where there's less competition or the like. That's another way to use mergers and acquisitions. So some basics in terms of the language here. A merger is basically combining two existing companies into a new company, a new legal entity. Usually, I would say that usually, from at least my experience, the merged company takes on the name of one of the predecessor companies, but it's technically a new legal entity. They technically issue new shares. They may not require you to actually turn in your shares and give you new ones, but they might just kind of I'm fishing for the word in my mind. So they might just basically recharacterize some old shares as new co-shares. That's a merger, bringing two companies together that way. Acquisitions, on the other hand, tend to be where one company acquires the other. You're not combining the two. One company's the buyer, one company's the seller. And the company gets acquired and in effect becomes a subsidiary of the company that acquired it. And then lastly, acquisitions, you might also hear the word takeover in kind of the nuance of financial language. The takeover is often an acquisition that's not very friendly. Okay? A hostile takeover, it's often called. But you hear that term as well. It's still an acquisition usually. It's just not a friendly one. So those are terms based on what typically drives the structure of this transaction as either a merger or an acquisition is tax considerations. Sometimes some legal things as well, but probably the single biggest driver is tax. There's a different potential tax outcome for the shareholders in a merger versus an acquisition. Mergers can be structured so they don't create tax events a lot of times for the shareholders of the company that's kind of getting acquired. Whereas an acquisition will always trigger a tax event. You're handing in your old share, you're getting some value for it, and you've got to report that on your tax return, whether it be a gain or a loss. But based on empirical data, the optimists who observe this M&A market say basically at best acquisitions are only successful, or mergers and acquisitions are only successful half the time. And we'll see some statistics later that suggest it's even less than that, considerably less. Yeah.
What does success mean?
Success, as I've seen described, and each sort of observer that writes an article about it has their own definition. A lot of times it'll be basically the forecasts that they give in the market on how the combined company will do don't get anywhere near close. They don't achieve the synergies they talk about. The combined company doesn't have the combined profitability they guided the market that they would like to, or something like that. Or they don't achieve the growth, et cetera, et cetera. Yeah, Paul.
So I have a question. I can see in a press release that, for example, they offer from Newmont Uniqueness by the company. They offer 100% of the shares to buy 100% of the shares, but the company is going to be distributed in part. 70% is American, and 30% is going to be outside. What does it mean? It's for tax purposes, or probably it's a different.
So it's a merger. It's being done as a merger, as I recall. The it means that basically, when Newmont issues the new shares to the Newcrest shareholders, they have a specific exchange ratio that they've negotiated where you're going to, if you're a current Newcrest shareholder, you're going to hand them your share and you're going to receive 1.025 Newmont shares in return. And then you're going to own the Newmont shares. Well, in the process of buying out those Newcrest shareholders, they're in effect issuing enough shares that when you look at the total combined company afterward, the Newmont holders that existed before there own 70%, to use your number. I can't remember what the precise one was, but 70%. And the Newcrest shareholders who now own Newmont shares are going to hold about 30% in the combined new company. Does that make sense? That's how the merger transactions structured as far as the press release says. We're going to talk about the Newmont Newcrest merger in a little bit here, just for fun. So with these big transactions that happen, any merger and acquisition transaction can have some pretty significant financial effects on a company, right? Klaus mentions Newmont Newcrest. Newmont's going to have a whole bunch of new shareholders and a whole bunch more shares outstanding. Its market value is going to go up a lot, assuming they can accomplish a lot of what they've announced. That's a big impact. Capital structure is going to change. A lot more shares out there. In this case, they're not taking on a lot of new debt, but they are assuming Newcrest's debt. So the debt structure will change. They'll have some cash, since they're buying it all for shares, whatever cash balance Newcrest had is going to be now in the combined company. There's going to be dilution for these Newmont shareholders in the sense of they, used to own 100% of Newmont. Now they're going to own 70% of the new Newmont Newcrest combined. So they're losing a little ownership percentage. It's going to affect future growth prospects. Prospectively, it's clearly going to affect market value. It should increase. They're talking about, I think, a run rate of something like 100 million a year of cost synergies that they'd like to achieve. And of course, there'll be tax effects because you've got some new tax jurisdictions that'll be involved.
What was that last? You said like 100% of the cross synergies?
100 million of cost synergies. So they're saying that by buying Newmont, when you buy a new company, right, that company had its corporate staff and corporate headquarters, which you no longer need because you've got your own. So those jobs can get whacked and you've got cost savings. And they're saying when we look at what's combined here, the locations, the operations, how we can manage it, we think we can probably reduce the cost structure by 100 million a year. Okay. That's what they're at least telling the world. We'll see what happens in real life. So you take on these effects, it's like, what could go wrong, right? What could go wrong in business? Well, lots. On the financial side, there's this thing that we have as humans called optimism bias. We might be willing to pay more because we're optimistic than maybe is what we're buying actually worth. So overpayment's a risk. Information asymmetry is an interesting one. Anybody want to speculate on what that might mean? So the buyer, right, Newmont in this case, if we stick with this particular one, you've got all the information that Newcrest publicly disclosed, right? You've got access to all that. You've got access to whatever you got from them in a negotiation. But you shouldn't expect that you know everything about Newcrest, right? Because you haven't lived it. You're buying it. Newcrest, on the other hand, is just, they're getting out. The shareholders, the information asymmetry isn't a big deal for them. It's more from the buyer's standpoint where you can't know everything about the company. And you're taking a risk. There's a risk to that. And sometimes it jumps up and bites you. You know, interestingly, when I worked at International Royalty Company, we had my chairman and CEO had assembled basically in the company the largest royalty on a property that many of you might have heard of that straddles the Chile-Argentina border called Pascua-Lama. Pascua-Lama had some huge environmental challenges that Barrick found out about after spending, I don't know, $6 billion or whatever they spent on it. And they'll never get it into production probably. But when Barrick announced they were going to build it, our company, having the best royalty package on that deposit, within like a week, got a call from Franco-Nevada. And within a week of that, got a call from Royal Gold and said, hey, we'd like to sign confidentiality agreements and take a look at your portfolio and especially the Pascua-Lama royalty. And we ended up getting out at a good time. But of course, they couldn't know at that point, informationally, that Pascua-Lama was going to have a huge problem. Barrick had just said, we're going to spend billions to build it. And they thought, great, we're going to get the royalty. But it didn't work out so well for us.
This may be a little bit off topic, but what does a royalty package?
What does a royalty what?
Yeah, what does a royalty package mean? Like when you say that, it's like.
Oh, there were. Yeah, when I say a package, there were several different owners of royalties on different parts of the Pascua-Lama deposit. And they negotiated with a variety of those. They didn't have every royalty on it, but they had several of the royalty owners sell them their share.
Thank you.
Or their piece. Yeah. Yeah. So that can be a problem. A misunderstanding of how the company you're buying actually creates value. This is an interesting one, maybe not as big in the resource space as it is in some others. But if you don't really understand how the company you're buying creates value, you can't be sure that you're going to be able to create that same value or the value you hope for. So sometimes companies get that wrong and overpay in effect. Regulatory hurdles are always an issue. We'll talk about that a little more. You've got a new debt load or capital structure you've got to deal with. You've got the perception of the equity market to deal with. Because as soon as you announce a deal, actually, does anybody know, have you looked at mergers or acquisition situations enough to know that what typically happens to the buyer's stock price on the day they announce they're buying a new company? It goes down. What happens to the target company stock? It goes up. Usually that's the format. But how much they go up or down is all affected by the market's perception of, is the deal a good deal? And what are the chances of it actually getting done? That all shapes the risk in here. Is the market potential really there? That's a risk that can go wrong. Integration risk and culture clashes is a big deal. I've seen some studies that suggest that the main reason why M&A transactions are not successful is because they don't figure out how to integrate the two cultures and the like. So those can all be big risks. The people risks are huge in any merger acquisition transaction, including in the commodity space or the resource space. It's rare that, other than sorting out senior management, it's rare that the buyer of a company really digs down into the personnel structure of the company they buy. They get, the important things. I don't know if you let's see, a little over 2 weeks ago, I think it was, Chevron announced they were buying Hess Corporation. Hess, old family company. The chairman and CEO is still John Hess. I don't know if he's grandson or who of the founder, but John was ready to get out. He's just accepting a board position with Chevron, so he's going to pull back, it sounds like, from day to day trying to manage a huge multinational company. But the people issues are always really critical to how do you get these sorted out. And we'll actually talk about an example of where the people issue was a driver of the M&A side. But it's rare that there's an inventory that, people know when you get down into the sort of where the rubber meets the road, where the business actually deals day to day. Oftentimes companies don't know who's there and who's critical. And not surprisingly, when companies buy each other, what do employees often do of the target company? The company that gets bought.
Make sure they have their resumes.
Yeah, they get their resumes up to date and they leave. And unless you have a plan for that, you can lose a lot of people who are important to actually making money in the target company. But companies seem to rarely really focus on that. They focus very heavily on the top. Can we get the managers and keep them? But they don't go down very far beyond that. And that can hurt sometimes. That's a risk that can really jump up and bite you. So I mentioned 50% was optimistic. So there's a Harvard business study that suggests 70 to 90% of mergers and acquisitions fail in terms of meeting what they tell the market they're trying to do. A KPMG study, one of the big accounting firms, came to 83% of mergers did not boost shareholder returns. Well, if you don't boost shareholder returns, it's like, what do you go through all the brain damage for of a merger or acquisition? You're in the business of trying to maximize shareholder value. That's the mission of the corporation. If you don't get there, you're going through a lot of, much ado about nothing, right? If you don't actually get there. What goes wrong? The Harvard Business Review article that there's a good one on this says you either overpay to leverage the business model. That is because you feel like the resources and you know how to manage that. You overpay for that because you think that that's got a high value. While sometimes to reinvent the business model, the business you don't know as well, you might underpay for that and miss the opportunity, or end up with some less than gruntled or even disgruntled management of the company you acquire, because you're not paying what maybe the value should really be. So those can clearly go wrong. You can have all these integration mistakes where you didn't really understand what you were buying and people left and all that stuff, or your timing can just be bad. Yeah.
My question is, with all this experience of measures failing, meaning there should be some degree of work being done to see why all this marriage of convenience are all failing. But why is it that it's happening and it's not, long-sighted, but within a very short time, you see them crumbling down?
Well, it's back to those why things fail. You've misestimated, or it's this get back to the slide. It's these risks that typically fail, and you end up writing off billions of dollars or hundreds of millions of dollars because you paid too much. That's how it reflects, and people study it, but it's not unlike actually one of my colleagues in the royalty business made, I thought, somewhat obvious but nevertheless astute observation of, he said, do you realize that every mine in the world had a positive feasibility study?
Yeah.
Right? Every one that's ever been built. Well, BHP built a nickel mine in Australia a few years ago called Ravensthorpe. They built it, spent their hundreds of millions or billions of dollars, and they never operated because the nickel market had gone down, and they never really put it into operation. But it had a positive feasibility study. It's like people think, this time it's different. We're optimists. So yeah, this merger and acquisition is going to be different. We're going to do it. And yet, when a lot of people study it, yeah, you do it, but you don't achieve what you thought you were going to achieve. And yet people still think that's sometimes the best way to maximize value. You know, and especially in the resource space, right? Where you're working with finite resources, you can acquire another company to build your resource to sustain or extend the life of your company. And yet, you know, you don't always know exactly what you're buying. So things still go wrong. It's an interesting business. We mentioned the governments sometimes get their hands involved. So the governments, US government is the example here, but the governments are worried about making sure competitive markets stay competitive, right? They like free markets, competitive markets. They don't like monopolies, oligopolies, you know, that's a big deal. If you're going to affect the market structure that way, they tend to frown on your proposed transaction. I don't know if any of you, one of the prominent ones, I guess, a few years ago in my mind was when T-Mobile wanted to buy Sprint or vice versa. And they got heavy oversight from the Justice Department, particularly the antitrust division, and basically said you can only complete this transaction if you sell off, basically create a new competitor. If you sell off this big chunk of the cell phone business to another company. The governments are very sensitive about this. And so you have a few different acts in the US that they use to make sure that mergers and acquisitions preserve competitive markets. And that's yet another risk. And I had, I guess, the experience on the acquiring side to find out that the SEC actually can review and pay close attention to an acquisition of almost any size. Yeah, David.
I didn't have a question about that because I really like video games, and I swear there's a point to this. So I really like video games. One of the things that happened is Microsoft has wanted to. They've been acquiring a lot of. When I say smaller, I mean they're just little multi-billion-dollar companies. And the issue that they're having is they're having to like negotiate with like different. Like, oh, what's your definition of monopoly? Okay, that's how we'll take care of it in the US. Now, what's the UK's definition of monopoly? Yeah. That's how we'll take care of it there. That also then true in like the mining, or I guess it would be safe to assume that's true in all sectors where not just like the US you have to worry about. There's multiple jurisdictions you have to worry about.
Absolutely.
Okay.
Yeah. That's part of running an international company. Yeah, you live with different rules all over the place. Permitting is prominent area that has different rules, right? You can despite environmental standards that I would say are just as good probably as the US, you can still permit a mine in Canada or Sweden or Australia a whole lot quicker than you can in the United States. You've got to deal wherever you're at. Yeah.
So in the 90s, when Microsoft was trying to improve her competitive position, she was always buying any new innovation and absorbing it into the operating system. However, years later, decades later, the European Union penalized Microsoft for that reason. Where do we place this in terms of trying to improve your competitive position and also flouting regulations outside your jurisdiction?
I mean, you hopefully get good legal advice everywhere you're dealing. That's the best you can do, usually. And if the government decides that you've affected a market or something, they may extract their pound of flesh. You know, whether that's causing you to pay a fine or whether that's causing you to spin something off or something. You just, you do the best you can at the time. The governments take a look. They either give their approval or not. You get the transaction done, but it's not unheard of that it comes back to haunt you. There's a little bit of a problem when you get too big. I think in Microsoft's case, you've got this big target on your back. And so governments look closely at everything you do, right? Your browser, and Alphabet's in the thick of that right now. Google
Okay, goodness.
with the US Justice Department, same thing, getting closely looked at, but I can confirm that the SEC, if the SEC doesn't have much to do, at least I'm gonna attribute it to that, it'll look at really small transactions. It looked at one of mine, years ago, that was really small, at least, you know, it was a $47 million transaction. When, you know, there are all sorts of hundreds of millions, billions, you know, a lot more tens of millions than we were doing. And we got a full SEC review. We put together with good lawyers, knowledgeable lawyers, good, we thought, full disclosure documents. And they they reviewed our documents and came back with like 90 comments, 90 changes they expected. And we made the 90 changes with our good lawyers and sent them back, and they came back with a letter that said, we found these 32 more. And we sent them, you know, we fixed the 32 and sent them that, and then they came back and said, oh, we found these other 19. And when we finally got it down to 9, they said, okay, you can do your deal. But the legal costs and the time, and it was just really frustrating. But they can look at anything, and you have to convince the regulators, or you have to basically go by what they tell you, or you won't get your deal done.
But does SEC has jurisdiction over the privately owned companies, or is it just public?
It's public that they really care about, disclosures.
So if the acquisition.
Although if you are a public company and you're buying a private company,
Right.
they'll still look at the transaction.
But
As long as it's affecting, you know, the SEC sees itself as the protector of the consumer and the investor.
Correct.
So if the buying companies, it's their securities that are out there, you can even be buying a private company and you'll get potential SEC.
But if you have a merger between two privately owned companies, does SEC has their jurisdiction or no?
As long as you're going to stay private, you don't have to get an SEC review.
Got it.
Unless they decide, well, no, that wouldn't be the SEC. Unless the Justice Department decides you're
I see.
gonna affect the market from an antitrust.
Market manipulation.
Yeah.
Right.
Yeah. So, interesting phenomenon in the M&A world. Have most of you done any investing? A little, you know, buy stock here and there? Most of us, I think, who invest think the right approach is buy low, sell high. Right? That's the idea. And make a profit. Well, you would think companies as investors that they invest in merger and acquisition transactions. That would be a logical thing for them to do. But this is just a phenomenon. This is a little old data, but it illustrates the point where when commodity prices are low, the black line's copper, the blue is aluminum. When commodities prices are low, not much happens. When prices go up, a lot happens. If you're trying to buy low, sell high, is that counterintuitive? A little bit. So why would that happen? Any thoughts? Why does that happen?
They have the equity to actually leverage for acquisition.
Okay, you're actually making money and increasing your equity that you can actually use to acquire your and your equity price is going up usually when the cycle's going up. So if you're going to use stock as your currency for the transaction, it's probably more attractive. That's certainly one reason. Any other thoughts?
False optimism.
Optimism?
Yeah.
Yeah. Cycles, you remember? Well, you haven't, maybe, I don't know how long you've dealt in markets, but there is this mentality in in cyclical businesses like mining or petroleum, whatever, where when things are going up, they're always going to go up, right? And when the cycle comes down, they're always going up. You know, it's like, we're never going to get out of this. When I think that's part of it, certainly the optimism in an up part of the cycle. You know, companies, I use the term companies are people too. You know, companies at the end of the day, it's their management and boards. You know, when you think about just people, your feelings, you know, if you work in a cyclical business and you're in the up part of the cycle, you probably just feel better, right? Easier to get somebody's approval on the board when times are good, right? When times are bad, it's tough, right? You use these projections that show the cycle's going to turn back up, and it's like, well, you know, I don't know, that probability of that, maybe not. But it's actually, I thought even more interesting, similar time frame with the gold transactions. There were so many I couldn't sort of put enough boxes on, but down here a few, up there, the floodgates opened, right? Transactions all over the place. The same sort of phenomenon where, yeah, in theory, you'd want to buy low, sell high, but in reality, to get the approvals you need, to get the seller to sell in your transactions, usually it's when times are high. So, quick last topic, accretion dilution. Have you heard those terms? Accretion is basically when you've added value, you've built value through your merger acquisition transaction. Dilution, you tend to be reducing value of your share. So you've got so many shares outstanding as the acquiring company, you're handing out shares as part of the currency to get your transaction done. And analysts in the market and everybody else, and certainly the companies themselves, look at what's my share worth before the transaction? What's it worth if we get this combined, whether or not we get the synergies we're looking for. So accretion dilution is basically all considered on a per share basis. It's only used when you're using stock as the currency for the transaction. And you're basically looking for, is my share of stock going to be worth more or is it going to be worth less? Because as a share owner, you actually technically own this minuscule percentage of the company, typically. You're actually an owner of the company if you own a share. Right, so you're just looking, is my share going to be worth more? Is it going to be worth less? We're going to take a look at a couple of examples. A few prominent transactions. In the mining space, Barrick bought Randgold in 2018. We'll look at that a little bit. Goldfields bid for Yamana. You'll note that Barrick's is the only one that says it's completed. So Goldfields tried, but they ended up losing to a higher bidder for Yamana. And one of the phenomena that happened in the M&A business is once there's an announcement that these companies have agreed on this transaction, that one's going to acquire the other or they're going to merge, what you do is in the financial vernacular called putting the company into play. Okay. You basically are alerting the world that this company you're acquiring is willing to sell. And sometimes that attracts some other interest, other bidders. And that's what happened with Goldfields Yamana. That's why it was announced but never completed. Chevron Hess, it's just because it's so recent. We'll take a quick look. And Newmont Newcrest, we talked about, also very recent, although a few months older than the Chevron deal. But I just worked up some statistics, M&A statistics, financial statistics for these companies. So Barrick Randgold. Barrick is the survivor, the acquiring company. Randgold is the target. This is what, based on the announcement that the companies made, the press release announcing their transaction, this is what would happen to a Barrick share. This is what the values were based on the most recent 12 months up to the transaction. Their revenues, they generated $6.21 a share. They generated EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a proxy for cash flow. They generated cash flow of $2.28 per share. Operating cash flow $1.71, free cash flow, which takes out capital expenditures, capital spending from the operating cash flow, only 31 cents a share. But with commodity companies or resource companies in particular, you have at least two distinct audiences of shareholders. Some of the shareholders are buying you for your financial performance because they expect you to generate profits. Some of them are buying you as a proxy play on the gold price, in this case. So the reserves per share, the production per share, the resources per share are proxies for that audience. They want to know how many ounces per share does this investment get me. So beforehand, you see the before, this is what the Randgold shareholders were making. This was an interesting situation where Barrick had struggled value-wise for a couple of years. Management was not highly regarded. And Randgold, on the other hand, had spectacular management, as it was seen in the market. They had, while I think Barrick's share value had fallen something like 60% in the 5 years before this transaction, Randgold's had gone up 90%. So dramatically different companies. So what do you notice about if you're a Barrick shareholder, your value here versus your value as a combined company? What's happened?
It's gone down.
It's gone down. Why would you do the deal? Why would you still go through with the deal?
Hopefully to go up again.
Hopefully to go up again. Good point. At least coming from an industry perspective, the reason why Barrick did this deal is they wanted Mark Bristow, who was the CEO of Randgold. They really wanted him because of the discipline he'd had growing the value of Randgold by 90% in the previous 5 years, while Barrick had lost 60%. They really wanted him. And they were willing to dilute the shareholders to get him.
Just one person.
Well, that's
Team.
that's maybe a little embellished, but that's how the industry would, if you needed the elevator pitch in the industry, why do they do this? They did it for Mark Bristow. Anyway,
Wait. They did it for him or they bought him?
They did it what?
They did it for him or they bought him?
They did it because
Oh, they acquired the company
Uh-huh.
and he ended up being CEO of the combined companies. That's what.
So was that a favor they did him or they actually, I don't know.
They acquired the company, which he was
Okay.
a prominent shareholder in himself, but
company and his team.
they bought his company. But supposedly it was to buy him.
I understand now.
Goldfields Yamana. This is Goldfields versus before versus after. What do you notice? Good deal for the shareholders, bad deal.
Too bad.
Even if they come up with the synergies they come up with, they are losing value. So why would Goldfields do this? Any thoughts?
Paul, can you hear me? This is Tom Brady.
What's
Well, I
that?
was saying maybe maybe to expand their market or resources.
Goldfields, I've not seen a lot of real meat around why they really did this or why they proposed this. My guess, because when I worked for JP Morgan in London years ago, Consolidated Goldfields was one of my clients. My guess is they have been so tied to South Africa and tried many times to kind of diversify, but not very successfully. And their fate was still very tied to South Africa. And in the mining business, especially mining those mines that have been going on for decades, at some point they run out and they've got to diversify. And I think they felt that way. And they were again willing to do a deal that diluted the shareholders up front to do something hopefully long-term that would broaden their scope internationally.
So it's more venturing into new areas.
Yeah, new areas.
I agree.
Yamana was very heavily in Latin America. That's where their assets were. So Chevron Hess, I just thought this was kind of fun. Chevron Hess, what do you see about the value? Diluting them. Diluting them a little bit. This was an interesting one because most mergers and acquisitions, the typical premium that is paid for the company that's being acquired tends to run about 25 to 30% of the value. That's kind of common. The announcement with Chevron and Hess was the acquisition premium was 10%. And I thought that was interesting. And I thought, why as a Hess shareholder would I accept it? One. And two, why would I stop at 10% if I was Chevron to get the deal done? And I think the answer for why would I stop at 10% for Chevron is I'm already diluting the shareholders. right? Even with that small premium. And if Hess will take 10%, we'll do it. Well, Hess, I think, on the other hand, this is one of the interesting anomalies in M&A. The day this was announced, not surprisingly, Chevron share price did what? Went down. Guess what happened with Hess share price? It actually went down.
Oh,
I think because the shareholders were less than impressed at a 10% acquisition premium. However, this putting into play might be a factor. If you remember what Chevron did a few years ago in trying to buy Anadarko, Chevron doesn't own Anadarko today. Occidental came in and outbid Chevron for Anadarko. And the shareholders did quite a bit better. Chevron, I think, was actually complimented for not going too far in the bidding war. But from a Hess point of view here, they know they're getting put into play. So Hess will do the deal potentially to just get the bidding war going, see what happens. Last but not least, Newmont Newcrest we talked about. How did Newmont do?
Not too bad.
Accretive.
Yeah.
Pretty cool. It can be done. Interestingly, for those of you who remember, again, a little M&A mining history, when Barrick did Randgold, on the heels of that, Newmont bought Goldcorp. Guess what? Newmont also, with the Goldcorp transaction, was able to structure an accretive deal for Newmont shareholders. Newmont seems to have an ability to identify and then negotiate transactions that are accretive for the shareholders. That is kind of cool. I don't think they necessarily get a lot of credit for it in the market, but they seem consistently to be able to find transactions that create value, both for, in this case, both for the financial folks as well as the folks that are playing Newmont as a gold price proxy. Pretty cool. So overall, you know, a couple accretive, a couple dilutive, but I would say the takeaway is caveat emptor. Speak Latin?
no.
You know what caveat emptor means?
Buyer beware.
Buyer beware. This is the M&A world. A lot of risk, but a lot of opportunity if you do it right. That's Newmont's found. Sorry, we don't have much time for questions. So I'm going to start. Thank you.
The question is, public-private partnership, does it have to place in merger and acquisition? Then, some company goes to the region of a country, probably to another continent to start a new company, and the country, country now say, you can run your company for 20 years, for 30 years, and eventually you give it up to the country where you invest in. So can we call that an acquisition? Questions.
Actually, that would typically be for the private company that was involved. Right. That would typically be a divestiture, giving the mine to the country. Right. That would be the opposite of merger and acquisition. You're not acquiring, you're divesting. You're giving the operation to them. And public-private, you know, one of the things that we look at in the finance classes I teach is goodwill and minority interests, where that you might have a particular subsidiary or an operation where you're sharing the ownership with somebody else. They've got a minority that you have to account for on your balance sheet. You have to record that on your financial statements, but they don't control the operation you do. That's a minority. And you have to record those, but it doesn't really involve mergers and acquisitions usually, because it's a project you decide to do with a local partner or something like that. But if you give it away or spin it off or sell it to somebody else, it's kind of the opposite.
I have a
Online
question.
questions.
Yeah.
No, you can ask first.
Okay, I wanted to ask, with all the ratios of failure to success, why does anyone still bother going into mergers? And why would there be such high rates of
Back to your question.
failures with all the due diligence and all the advisory jobs that are done?
Great questions.
And the second thing I'd ask is, with spin-offs, is there any provision for the company who is spinning off a business to kind of own a minority share in that spin-off, or it's prohibited?
In a spin-off, it can be structured that way, but it's contractual. You know, you're just dealing with the company that's going to buy. And if they are okay just holding a majority and leaving you with a minority, you can agree to that contractually. That happens. What's the first?
Okay, asking about why people still going.
Oh, why do you do it in the first place?
Advisory work.
I think one, optimism bias. You know, two, you know, it's kind of like I had a discussion with the CEO of a gold company that I was on the board of, and he was talking about his guidance that he was going to give the market in terms of what we were going to produce and all that year, and he was coming up with a number that he said they built very carefully. They talked to each of the mine managers and got their conservative estimates, and he came up with his number. And then I said, as we were talking about at the board level, I said, well, so what, you know, how much should we cut it back? And it's like, what? Cut it back? And he said, why? And I said, because stuff happens. And if you look back, you know, historically, have you ever raised your guidance? No. Have you ever lowered your guidance? Yeah, just about every year. It's like, well, I don't know what's going to go wrong, but something is. And I think we have this optimism bias that somehow it's different this time. Right? We can do it and we can be successful. Well, you know, maybe you can, but you've got this information asymmetry that's important, that they know what they're selling a lot better than you know what you're buying. Right? And sometimes they take advantage of it. And you know, you go through the transaction, because I will tell you, just from being in the trenches, transactions sometimes take on a life of their own. And it's like, yeah, you might hear this little bit, this might come up, that's that, but there's this momentum to get the deal done. And you go through with it anyway, and sometimes you pay the price for that. Yeah.
How long is the merger and acquisition process usually? Like, if you can generate a bidding or that kind of stuff, because one of the issues is time it takes to bring an asset online for mining companies, if you're doing it from scratch. So how does that time scale compare to a merger and acquisition time scale?
Well, given the permitting process, it's a whole lot quicker to buy something, because you can get a merger acquisition deal done in 60 days. Once you've negotiated, you know, that you've got to then, there's lots of things that have to be done. Like, if it's significant enough, you've got to put together all the disclosure information for shareholders who are going to vote on both sides. Maybe you have to just go through that process, but you can typically get an M&A transaction done in 60 to 90 days.
Okay.
And if something's operating, you know, you at least know you've got an operation that you've added, rather than having to go through the permitting process and all that stuff.
Okay, thank you.
Yeah.
There's one question here, though it has been answered by another person. This one is asking, what is information asymmetry?
Information asymmetry is the difference in information that you have as the buyer of a company from the current management of the company who's selling it. So it's a different level of information that you really get to understand what you're buying. Is that clarified?
Yeah. Okay. Thank you very much. Thank you.
You're welcome. Oh, probably shut up.
Yeah.
Mr. Brady.
I know the two. Hello. If you want to say something to you.
What's that?
I said, oh, you want to say something?
Okay. I don't know, we went over time here with our late start. Okay.